Hey, Kevin here, top 100 financial advisor and best-selling author, and we are here to talk about the stock market. I got an excellent question on Public the other day, and the question was about investing styles. How do you decide what style of investor you're going to be? Do you look at returns to pick a style? Like what is it? What's the key to figuring out what style and what type of investor you're going to be? Excellent question, and there are a few things that we need to discuss. So first, you don't have to just pick one style. So I'll kind of lay out like where I am. I am in between two that I've just fallen in love with that happen to make a lot of money, or happen to have consistent returns and that I enjoy and it fits with who I am. And I think that's the big thing. You have to figure out, number one, what are your goals, and then number two, what fits with you and your work style and your lifestyle. Because, for example, day trading is one style of investing. Now, the math and the studies say it's not an effective one, but I'm gonna set that aside for another day, right? However, somebody who's got 2 kids, somebody who's got a business, writing books, writing articles, I personally do not have time to do that. I don't have 50 different computer screens, and while I can read charts and do that type of stuff, I just don't have time for it. So, for example, at 9:30 every morning, I'm taking my kids to daycare, and then I'm hopping on meetings. That's just me. That's just not my style for me, okay? But everybody has their own. So I'll walk you through some. I have a list here, and then we'll kind of have a discussion around how you find that. I also say that you can drift and start one way, and over the years you switch. Like it can be a fluid thing. You can have multiple styles in different types of accounts. And I'll walk you through how that works for me as well. All right, so the first one is active versus passive. This is, the Lakers, Celtics, Yankees, Red Sox, Oklahoma, Texas type of thing, where it's like these two things always clash against each other. So active, when you say active as a style of investor, active can be, I'm trying to think of a good metaphor for it, but active is you being more hands-on. So imagine you get a flat tire, or if you're an active investor, you get in there and you change the tire yourself. When the market drops or the market does something, or you start to see the financial stocks are taking off, you say, hold up, let me go in here and let me get some finance stocks. Market drops, you say, hold up, well, let me go in here and get, like I was saying last year, Costco, Dollar General, Kroger, let me get those defensive stocks, right? So that is your objective. When you are active, you're trying to get in and react to what's going on and make those moves. Passive says, I don't care what's going on, this is what I'm doing. Whether it's a stock, you can be passive with stocks and say, these are my 10 stocks, I'm not selling them ever, or I'm not really making any adjustments except for once a year or something like that. That's passive. You could also say, and this is most common for index funds, where I have index funds, I have ETFs, exchange traded funds. That's a group of stocks, a basket of stocks together. Say, look, this is what I'm getting, and I'm just going to keep pouring money here, and I don't need to worry about it because I'm passive. And I know these funds adjust on their own in time. I know these funds have been successful. Either one of them can work, right? Depends on what active style you have and what type of passive investments you hold, but it depends on your style. Do you want to be hands-on? Do you want to get your hands dirty? Do you want to know enough about what's going on and know enough about how to react, right? If you're hands-on and you know how to fix a tire, you got to get your hands dirty. You have to have a spare tire, and you got to know how to do that, right? You can learn those skills. It doesn't have to be super difficult, but you have to know that. Or you could do nothing and just say, look, I'll call AAA because I got my index fund here and I can have them take care of it. So that depends on, do you want to get your hands dirty? Do you want to know enough to be able to react to those certain things? A great example for me and my investing style, a part of my investments are momentum investments, or a momentum investor rather. I try to pick companies that have done well recently and I think will continue to do well. So I have to sit down and say, look, based on what I've seen over the last X amount of time, banks, electric vehicle stocks, those have done well. I need to make a few tweaks and hop into those, right? I had to go and do that research. Now for me, I don't think that's strenuous. I don't think it's difficult. But I've also been doing it for a while. But I think that's right in the range of what I can do, what I feel like doing, because I don't feel like doing everything, and something that I know works, and we've got data to back it up. So those are two, active versus passive. We can do an entire video on that if y'all want. Just ask. So the other one that's really popular in terms of style is growth versus value. Growth is the company where I'm looking, where I think I can make I'm throwing a number out here, 20% a year, 25% a year. Think what Netflix used to be before it's Netflix now. Netflix in 2020 was named the stock of the decade, right? Think of Neo, right? Neo had grown a ridiculous percent. You can throw GameStop and AMC in there. I personally wouldn't, but again, that's growth, right? I'm looking for companies that have a huge growth potential. When I look at Neo compared to a Ford, and someone brought this up in the comments on YouTube, that Ford is probably a more solid performer, whereas it goes up, it's probably going to grow more in a straight line than a Neo will. Neo's probably going to make you more money, but it ain't going to be a straight line. It's going to be hectic, and it might not be as fun, right? But you're going to get there. So that's an example. So growth investors, they try to look for companies that are small to medium size sometimes and have a bigger growth potential. Now, the downside to that is you don't actually know if it's going to work. You can have a lot of potential and never fulfill that potential. So that's the downside there. On the other side of things, you got value. Value tries to say, that style of investor is saying, look, I'm looking at a company, I think it's at this share price, I think it is worth even more. So I think it will grow in time, but I don't think people are really thinking about it. It's kind of finding like the hidden thing, the thing that nobody's talking about, and you're trying to say like, I found this company early, I think it's really good, nobody's talking about it, I'm going to go in here and get this now, and in time it's going to grow, and I'm going to profit from that. A good example is, so last year and even this year, people are focused on financials, as am I. People are looking at tech, and they always are. People are looking at Moderna, they were looking at vaccine stocks and doing all that stuff, right? Last year, and I've told you guys this, I was looking at O'Reilly Auto Parts. It's not a sexy company. It's not something most people are thinking about, but it was a value company. A company that was at a very good price that nobody was paying attention to, and now it's up 20-some-odd%. So that's an example of value. Is that what you want to do? Sometimes value investing can be really boring and really long, right? People cry about this all the time with Warren Buffett. That is what he does. He's a value investor. He's not trying to pick the sexiest thing in the world. He's trying to figure out what is the value of this company. Is it undervalued? Is it good? I'm going to invest it even though nobody else is paying attention to it now, but they will pay attention to it in time. What type of person likes this? People who like finding that kind of stuff. It's like finding that artist before they get real popular, and then it gets popular. Like, yeah, I was on that one, right? You might feel that way by being on the YouTube channel now. So that's the type of the type of person who likes value, the type of person who likes active, the type of person who likes passive, and the type of person who likes growth. And then lastly, another big factor, you've got small cap, which is small capitalization, can't get the word out, versus large cap. So think small cap as, think of like a Wendy's, right? A company that, we've all heard of Wendy's, but Wendy's is not McDonald's. So two different playing fields in terms of size, right? So the advantage of investing in large cap companies is you know what you're going to get. It's a little bit safer. They're probably not going to go bankrupt rather. But small cap companies have more growth potential, but it's also more risk, more volatility. Meaning those ups and downs are going to be a lot more hectic versus a Walmart. Like Walmart and Amazon, I know what they're going to do. Not going to go broke there, but I'm also not going to make 200%. Over a year or overnight even, right? Small cap companies have that potential, doesn't mean it will, but it has that potential because they have more space to grow. A good example right now could be a Dunkin' Donuts. No, I'm sorry, not Dunkin' Donuts, a Krispy Kreme. Dunkin' Donuts and Starbucks. Starbucks is large cap. Starbucks is already on every corner. You know Starbucks, you see Starbucks. You don't always know or see a Krispy Kreme everywhere. I lived in New York, there's one Krispy Kreme, it's 34th Street, Penn Station. Nobody wants to eat at 34th Street at Penn Station at all. But the small cap potential is that Starbucks is only, I keep saying Starbucks, Krispy Kreme is only in a few locations. They have the potential to go global. They've got the potential. Starbucks is already there. There is no potential. Not saying Starbucks can't keep going and making money, but like, I've got a lot more potential. I've got a lot more space for me to grow and do things. Starbucks is already there. So there are pros and cons on either side of that. We won't get into this video, but those are the primary investing styles. When you have to sit down and decide which one works for you, that's going to depend on who you are and what you have time for. When we talk about small cap stocks, it's a little bit more research and a lot more risk there. Talking about Krispy Kreme, they've had some financial issues. They were public before and then had to go private, and now they're public again. Why is that? Right? You might want to dig into the financials and ask yourself, why did you do that? What was the problem here, right? Was there a problem at all? Have you been around from the 1930s and you still haven't really been national? Krispy Kreme is still a very much regional brand, whereas Dunkin' Donuts, Starbucks, and others are already out there. So think about that, right? So there's more risk and more research when it comes to a small cap company. Large cap, you know it already. There's nothing to be overly concerned about, but it may not grow as much. There's your risk there. We talk about active versus passive. You have to have the tolerance and the will to go and learn more and be more hands-on. That's not necessarily a bad thing. Passive, honestly, I don't see too many downsides to it. There might be a little bias there. But the downside, though, is, for example, if I invest in the S&P 500, if I invest in something like SPY, has the top 500 largest companies, it normally does well. It's going to average you, going back to 1950s, like 7 to 9%. That's going to be okay. The problem is, if that goes down, I don't have any control over it. I just have to ride it out. Whereas if I'm more active, maybe I can shift my investments. Maybe some are better than others. Maybe I can shift my investments where I'm not losing money at certain times. Totally depends, right? But there's always a pro and con. And then lastly, growth versus value. It is harder to find growth companies and growth ETFs, exchange traded funds. And it can be hard to find value companies. The good thing is those ETFs do exist. So you can Google or even look up on public what's the best growth ETF. What is the best value ETF? And it'll give you a list of companies and you can invest that way. So that's another cheat code around these. But those are the investing styles. You have to sit down and sit with yourself and decide what type of investor you want to be. What do you have time for? And what works best for you. For turn wise, maybe growth makes the most, maybe. But it's hard to call because I could be active and invest in Google. I can be growth and invest in Google. I could be value and say, well, I think Google's undervalued, and that falls into that category. So it's really hard to say which one of these makes the most money. But the difference is the work that you want to put in and whether or not that matches your risk tolerance. I'm okay with being a passive investor most of the time. I'm okay with being an active investor, and sometimes where you guys see me every 6 months where I'm tweaking just small things here and there. I'm okay with that. I'm okay with getting my hands dirty twice a year. I'm not okay with being a day trader where I have to do this every single day. I don't have time for it. That's not for me, but it is for some people. So that's how you figure it out. The other thing is I would say is experiment. Invest in different things. See what you like. See what works best for you, and then decide. When I was an investor at the very beginning, I did try a whole bunch of stuff. I tried value. It really didn't work. I didn't like it. I invested, quick story, I invested in Micron. I did all the research. It took me, I don't know, maybe a week, 2 weeks. Did the research, invested in Micron, waited an entire year and barely made a profit. And I was like, yeah, I don't really like this. Got out of it, and then Micron shot up after. And that just wasn't for me, right? I think I'm more of a growth personality, or if I'm going to invest in it, I want to start to see returns, not immediately, but after a while, I want to at least be validated that I chose something that was good. And at the time, value just wasn't okay with me. I could not sit there and take it. But that's just me, right? Doesn't mean that doesn't work, because Micron, the time I got it, it's up, I don't know, 150 some odd %. Should have kept it. But that wasn't my investing style at that point in time. So decide who you are, try out different things, figure out what you like, and once you like it, that's when you refine your process. That's when you say, this is what type of investor I am, and this is what I do on a monthly basis, a weekly basis, a yearly basis to continue to feed this cycle, feed my investing style, and continue to grow my investing accounts. All right, let me know what you think. hopefully that wasn't too long. Let me know if that suffices, if that answers your question. If it doesn't, feel free to let me know. Let me know what type of investor you are. For me, I am a passive index investor. I also have some investments in what I call like momentum investor. So let me know what type of investor you are in the comments, and that's it. Talk to you guys later.